Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for December 22nd of 2024. Welcome, everybody, to the last Charts and Chat of 2024. Happy holidays to all of you. Hope you are able to take some time to be with family, and if you're traveling, I hope you are safe in your travels. So let's cover a few of the important items as we close the year. And the first was the Federal Open Market Committee meeting this past week. We had an interest rate decrease. You can see here that this represents another in the line of rate decreases from our peak interest rate level. You can see here that we did get a 25 basis point or 1/4% decrease in the rate in the announcement this week. So that brings us to a range of 4.25 to 4.5, and so the 4.5 here represents the upper bound of that targeted range, and you can see that this really does begin to have the feel of a normal rate cycle. And now that we're on the kind of the downside of it, a lot of expectations have been built into this rate easing cycle, or at least the easing component of this rate cycle. And what really surprised the market this past week was the statements by Fed Chairman Jerome Powell and also the dot plot, which we're getting ready to look at. And so it was a surprise to the market that had been expecting about 4 more rate decreases in 2025. It now appears that, at least by the estimates of the people that vote on these types of matters, that we're only apt to get perhaps 2 of those rate decreases. And so the market didn't like that. And as I've mentioned many, many times, market does not like uncertainty. But I will say that the market was apt to be sold off anyway, and this is just the catalyst that did it. But I still believe that we are in a rate easing component of the cycle. Where we go from here, I think is going to be very data dependent, and it may not look at all, because this is 2008. This is the global financial crisis. So that led to a very precipitous decline, and I see this one as being a bit more gradual. And again, like I said, it's going to be data dependent. Here we have the dot plot from the Federal Open Market Committee voting members. And so what each dot represents is a vote by the committee members themselves. And you can see here, exiting 2024, this is kind of where everyone was anyway, and this is where we are going to end the year at around 4.5%. But as you get into next year, and you can see this kind of this light blue line here, this represents the median plot. And so the current estimate, you get a lot of these votes that are coalescing around this, 3.75 or 4% range. This represents about a 0.5 percentage point from the end of 2024. And so what's interesting and what's important to note in all of this is that not every voting member feels necessarily that way. You have your outliers up here. And again, this is the estimate for interest rate, short-term interest rates at the end of next year. And of course, these projections go out longer, and these are so wide in terms of their dispersion that you could drive a truck through it. And I really take anything beyond a year with a complete and utter grain of salt, although we will show you what that longer term estimate looks like. But again, coming into coming out of 2023 and into 2024, I mean, we were looking at these same dot plots, and these things can be wildly inaccurate. And what I like to say is, like, you literally have some of the smartest people in Washington that are, when they get together and they talk about all this, I mean, they have very compelling arguments. But again, life comes at you fast, and data can change in a heartbeat. And so, these may not be right, but it is what it is today. And so the current estimate is for about a 0.5 percentage point drop in 2025. Here is that longer term range coalescing around 3%. This is longer run projections for the dot plots. And you can see that has picked up a little bit over the last several years. We have a little bit of a breakdown in the FOMC estimates. This is taking us from the September estimate through the current estimate. And, we've got a couple arrows highlighting some of the more important distinctions here, but, let's just cover everything on this board. So December, really not much change in overall estimates for economic growth. Still looking for around 2%. And this is for 2025, and that does ease down a little bit over the next several years. Again, not a huge shift. Unemployment rate, again, not a huge shift either. So looking for something around 4.25%, perhaps right now, and then that's expected to remain fairly stationary. Now, on the inflation front, and this is the other thing that got the market stander up a little bit, because from September through December, the estimates for inflation were increased a little bit. Now, that is expected to drop next year to levels that are very consistent with what they thought on the FOMC in September. And then also here we have core PCE inflation as well, the estimates moving up. So again, that was a surprise to the market that was not expecting them to talk about inflation. And as you'll see, some of the risk factors and some of the things that are on institutional investors' minds going into next year have kind of evolved a little bit over the last several months. Before we look at that, I want to show you the economic growth rate. This is on a chained year-over-year seasonally adjusted basis. And the current estimate for GDP growth is 2.7%. And it's actually not an estimate. This is an actual. And so this is looking at 2024. But I like this data series because it goes back to really 1990. And if you look at the line of best fit, it is very close to where we are right now. So this is very what we call like trend-based growth that kind of befits a longer-term average. Now we'll talk about some of those things that are weighing on people's minds. This is the survey from Alpine Micro, kind of what is the biggest potential downside risk in the market. So oddly enough, this is something that 6 months ago we would not have included in this list. Geopolitics is always in that list, somewhere between, perhaps 2 and 5 on the list, just because we have some tensions related to some turmoil in Syria, and not sure where that government's going to go and how that impacts the greater Middle East. We have the war in Ukraine, and you have these other things that could drive some economic variables. So inflation, geopolitics, protectionism, again, something that has always been out there since I'll call it Trump 1 and the 2018 original tariffs. And as trade and globalization kind of goes into reverse, so that's on that list. And then we have unemployment and fiscal crisis that is on that list as well. Unfortunately, with regard to this item here, we were able to avoid a government shutdown by virtue of what we'll call Plan C, a continuing resolution to fund the government for at least a short period of time. And but no doubt we will be taking this item up again in 2025 as it relates to the risk factors in the market. It's another chart from B of A. This is the Global Fund Manager Survey. This is what the fund managers see as potential headwinds in 2025. A global trade war, and again, here's that trade war coming up again. And this is literally the change between November and December, and so that has taken on increased prominence, and that's a big risk. Disorderly move in bond yields. Bond yields have been quite volatile over the last year. November, that was a big fear heading in 2025. December, not so much, but it's still very important. Anything above, I call it 20%, is something we should pay attention to. And then here, Fed rate hikes. So again, this is something 6 months ago, we would not have been talking about this, but November, we had about a 10 to 15% probability, or I guess this is not a probability, this is a preponderance of responses in the survey. So essentially about 15% of respondents said that this is this is a potential bearish catalyst, to use the parlance in the question. But that has increased quite a bit, and particularly with the Fed announcement this past week that they are a little bit more concerned with inflation, and that their own estimates of inflation for 2025 are a little bit higher. And then finally, US dollar, with the increase in inflation expectations, that has brought with it an increase in medium to long-term interest rates, which in turn has added renewed strength to the dollar. And so having a strong dollar is not particularly good for, exports. It makes our exports a lot more expensive. And so there are other disrupting factors there that need to be taken into consideration. This is another chart from the Global Fund Manager Survey. And so this is basically an expectation, the net number of fund managers, the survey, that are expecting lower long-term rates. And so, back here, that was relatively high. And, the peak was December of last year, at a time where everyone was looking forward to rate decreases. Well, that has changed in a year. And so with this higher, I guess, inflation estimate, if you will, and higher interest rates overall, the feeling is not as consensus as it was just a year ago. This is a quick check-in on inflation and kind of bifurcating goods and services. We've talked about this conundrum for quite a while. Data that goes back to 1984, and you can see this long-term trend line down in inflation. We had a spike in goods inflation when we had the supply chain issues. That really took prominence for a while. And then we had the service inflation, which followed. Goods inflation has really dropped, even though we had a little bit of a fishhook uptick here in the last reading. But services inflation remains elevated relative to this historical backdrop. Even though we've come off the peak, we're still elevated in service. And so when you look at inflation, it's not coming from here. It's all coming from here. Here we have trade policy uncertainty. This is from an academic paper. And it has an index which determines the trade policy, uncertainty that could drive that risk of economic disruption. So you see this time series going back to 1980. There was very little, I'll call it, amplitude in this wave here, in this trend. In fact, if anything, trade policy uncertainty went down when we were kind of ensconced in that whole era of globalization. Well, that obviously changed. We had the 2016 election that began the discussion of tariffs, and then we had all of these other instances of high tariffs, and then we had the election with Biden, but they remained elevated because all those tariffs remained in place. And then now we're obviously seeing a renewed spike in trade policy uncertainty. So this is kind of almost like a data-driven manifestation of the risk factors that we were just talking about from the fund manager standpoint. Now we're going to talk about shopping, and we're going to talk about retail sales. And this has been a real bright spot in the economy. And I know the charts last week were really on balance, very positive. And I still feel that way, even though we're highlighting some of these risk factors. But what we have here is an estimate of holiday shopping spending. And this is actually very impressive, considering that I'd say, lost the better part of a week just because Thanksgiving was so late in the month. And then obviously Christmas, which I think you all would agree with me, has come up way too quick. It's hard to believe it's literally next week. But nevertheless, holiday spending expected to move higher. That's a very positive thing. Reflects a lot of positive dynamics within the consumer sector. It reflects positive real wage growth and a whole host of other things. But you can see that this trend line moving up, very, very healthy. Now we'll highlight the retail sales here. This is retail food and service sales. The estimate was looking for up 0.6%. We actually got up 0.7%. You can see the last few months have been very positive. This is a monthly data series, so that red line represents the most recent reading, and that was good, better than expected. Where did that come from? We'll transition over here. What's interesting, motor vehicles and parts. So we had car sales that were heavily influenced, influential, I should say. And then we had basically internet retailers here and the sporting goods, and then overall retail sales showing up in the pink here. And then the control group, which kind of cuts out some of the more volatile elements, that was also positive. And where we have maybe some fallback, we've got clothing and food and beverage down here. Talk about housing for a second. We've got existing home sales, month supply. So, we've actually been looking at those months of supply increasing. So, typically we say right now we're about 3.8, even though that ticked down a little bit. I mean, overall, that's getting us closer to, I think what a lot of people would define as a, very healthy market is at 6 months of supply, even though we haven't really seen that for a long time. And again, this is global financial crisis here. So I'd say that is definitely outlier type data that I think, you have to smooth out. But again, when you look at pre-pandemic levels, I mean, we're not significantly, above or below that right now. I mean, obviously 2013, 2014, but you get into the prime pre-pandemic months, I mean, we're pretty much in line. Here we have existing home sales year over year, and this is also seasonally adjusted. What's really profound here, and you look at this bit right here, and so this represents, a significant period of declining existing home sales. And just to be clear, existing home sales are multiples of new home sales. I mean, these are existing homes that are changing hands. And look at this, we've got a green shoot right here. So we were up 6% here in the last reading. And that's the first time that we've seen any change since, probably 2021. Now, we did talk about increased interest rates at the medium to long end. And of course, mortgage rates, particularly 30-year fixed mortgage rates, are indexed to the 10-year treasury, which we know has moved higher. And as a result, mortgage rates have moved up. Now, this represented a period of kind of easing for home buyers. Unfortunately here we've got basically as of December, you've seen the continued trend higher in interest rates, and that accordingly has transmitted into the mortgage market. So it has hurt affordability, but it hasn't hurt it to the extent that, like in that reading that we just saw with existing home sales up 6%. So it's not completely torpedoing the residential market right now. And by the way, home builder sentiment has improved as well. Here we have volatility, so we're going to shift into investment markets now. So obviously with the rate announcement this past week, we had a huge spike in volatility in the equity markets. You can see, we're almost at 30 on the VIX, and so we had a little bit of a shock in July, but volatility by and large has been pretty low. So we were really overdue for kind of a hiccup there. Here we have from FS Investments kind of a chart plotting the S&P 500 in black. And of course, we've had this little bit of a pullback here lately in December. And at the same time, though, we've seen 2025 estimates, continue to ease down a little bit. I'm going to say that this was kind of certainly a rolling over. This is a time where we were talking about overall economic growth, kind of slowing a little bit to kind of the 2% level, which is where we're at now in terms of the Fed's own estimates. But, you see this interesting relationship here. Again, this is a relatively short time frame, so let's not get too carried away with the correlation. But, we were moving higher in the market at the same time that earnings estimates were moving higher. Well, now we have an environment where those estimates are decreasing, but yet the market still moved higher until recently. And so, again, I think estimates are coming in line to a point where they make a lot better sense. I think, just as we've seen over the last several years, that these estimates always, well, always, but they tend to prove conservative. And that's why we have a percentage of companies that report that beat their estimate, usually in the 70s to 80%. But this is an odd circumstance, and I think it may indicate maybe somewhat limited upside in the equity markets over the near term. Talking about valuations, we have the Case-Shiller CAPE ratio. So this is the cyclically adjusted price to earnings ratio. That's what CAPE stands for. And so this is really a longer term average. And when I mean long term, we're going back to 1870 basically. And you can see where the average multiple or the cyclically adjusted price to earnings ratio is around 17. And you can see that a full standard deviation is looking closer to like 2025. This is not the PE that's being published, but this is the cyclically adjusted PE. And so, long have made the arguments here, the people that produce this index, that we are greatly overvalued. And I don't disagree with that. I think the concentration of where that's coming from is rather unique because honestly, I think the structure of the S&P 500 has changed dramatically in the last several, really certainly in the last 5 years, but much more so over the last 10 to 20 years. And it's definitely not your father's S&P 500 anymore. It's a lot more technology focused, and those firms tend to always have higher and growth focus, and those firms tend to have much higher multiples. Here we have more information on stock market. This is a bit of a conversation here on the correction that we've seen, and particularly what we're talking about here is value. And I find this particularly interesting because I do see I see a valuation opportunity in the value style component. And so again, with the sell-off this past month, I think every area has been tagged, but this is something that you just never see. This is very odd that, we had this, it's almost kind of a slow bloodletting of sorts. And so we had a few days, the market was down. And then at one point we had, basically 10 days where the market was down. And then all of a sudden we realized that we've had, all of these consecutive days of decline in the overall market, and in particular in the value index. I mean, we haven't seen this since the 1970s. And what this would argue, and here's the relative strength index, what this tells you is that things have been greatly oversold. Now, of course, we did have a bounce back on Friday following the sell-off. So again, I'm not saying that we're going to continue to rise, because obviously I think multiples are a little bit stretched, but maybe we are a little bit more channel driven. We kind of trade in a channel, but clearly we were oversold in the value component. So here's a chart that shows us the percent of New York Stock Exchange NYSE stocks that are above their 20-day moving average. And again, another indication that we are oversold here is this indicator right here, because the percentages that of NYSE stocks over their 20-day moving average, daily moving average, has really dropped to around 12%. It's another argument for small caps over large caps, that we have expectations that are really beginning to build here for small cap outperformance. And you can see here too that we have earnings per share growth, S&P 500, again, dominated by technology companies, dominated by Mag 7, that those estimates are, while they're still going to continue to be positive, they're just not going to accelerate at the manner, by the degree, the degree to which the small caps, as defined by the S&P 600, are going to increase. So this is going to be very interesting to watch as a theme in 2025, assuming that we don't have a major economic disruption or if any of those risk factors don't particularly take root, that I would think that the size style investing is going to be an important factor in overall performance next year. Here's some money flows as of late. You've seen here banks, insurance getting a lot of money flows, U.S. markets. So we're still getting a lot of foreign investment dollars coming into us, and you can see bonds getting strong flows as well. Stocks getting strong flows. Where we're seeing the outflows is in the value components, staples, healthcare, and materials are much more the defensive components there. And we've also seen, because of the strong dollar, we've seen trade out of emerging markets, Japan here, and Eurozone in particular. We'll talk now about bonds and interest rates for just a couple slides here. We've got a 10-year Treasury term premium. So when the term premium increases, as it is now, it's usually a function of investors, the market pricing in a greater need for yield for the amount of risk that's being taken. So we have policy uncertainty with regard to interest rates. We have uncertainty with regard to inflation that we didn't necessarily have maybe 6 months ago. And what that's resulting in is basically, the longer your maturity, the more of a premium that you require for that potential volatility and for that uncertainty. With the increase in interest rates, we've seen notable outflows in certain sectors of the market. High yield being one of those, and high yield has been an area that's received a lot of inflows as of late because it's been a very strong performer overall. And what's interesting is that, when we felt like we might get a little bit of economic weakness, and particularly when we thought that maybe we were apt to have at least a mild recession, these money flows really didn't change tremendously. 2022, you saw a lot of people go to cash, but you still saw high yield as a category perform fairly well. And so it is interesting here as of late, though, with the higher interest rates that we've seen a dramatic outflow in high yield investing. Quick check-in on commodity prices. We've got the CRB spot price index that it remains relatively elevated, even though it has come down a little bit. Then we see overall commodity prices here in this green line, which during the pandemic, we had supply chain shortages. We saw a dramatic increase in a lot of those components. And then over the ensuing year thereafter, after the peak, we saw a rather precipitous decline, and we've been battling back. Now, we are seeing positive price performance out of commodities themselves at the same time that we're seeing, some improvement in global manufacturing PMI here. And although that hasn't really translated yet into changes in the spot price index for the CRB, I would anticipate that we're certainly not apt to fall, that commodities, I think, remain a viable diversification component of a portfolio. All in the chart pack with a few slides from Vanguard. Pretty interesting. This one speaks to really behavioral investing when you have actual trailing returns in the S&P 500. That usually will dictate what investors believe will happen over the next 12 months. And sometimes it works out, sometimes it doesn't, but you can see here the actual trailing returns in this amber line. And again, this is over, a fairly short period of time, I think net, but basically the underlying thought of this chart is that past is deemed to be prologue. And so when you have strong performance, expectations are generally for continued strong performance. Here's another chart from Vanguard. It just shows you that basically there's a strong bias when you hold assets that have lost money, that are below their basis, and you tend to have a much lower probability of wanting to sell those assets than you do on assets that have appreciated. So obviously you had gains in these and you want to take advantage of that. But when you have losses, there's a strong behavioral impulse to want to hang on to it in hopes that it gets back up to your basis. And so this is just another chart that kind of highlights that particular investment behavioral bias. And then finally, we have a chart that kind of speaks to, I think, what we all find fairly intuitive is that when you have up markets, that you're going to increase your stock allocation. And this is Vanguard's comment that you might be taking on too much risk by over diversifying in areas when, or particularly in the stock market when the market's going up, as opposed to keeping your blended portfolio. But then here we have no equity portfolios on this side, that when you're in a down market that you tend to increase or decrease your equity and take it out altogether, and then you wind up missing opportunities. And so I think this goes back to what an investment policy statement should look like. And again, you have ranges to operate within. So, whether you're taking on all equity, but or more than likely a blended portfolio here, I mean, you're never going to be out of the market per se. You're always going to be invested in the market. And so, these opportunities, particularly this one right here, but both of these, I think represent potential opportunity cost to portfolio performance by not being exposed to areas that may not be performing well at the moment, but have strong long-term performance upside potential. That's all we have for the chart pack this week. I hope you have a very happy and safe holiday, and we look forward to visiting with you again here in the new year. Take care. Bye-bye.